Okay. Uh, Thank you very much, John, for the invitation and the introduction. It's a pleasure to be here, see so many people. I know it's late, it's after dinner, so I'm going to try to keep it a little light, but give you an overview of part of my research, an area of research that I pursued over the years that I still feel very strongly about and think that this is something that we should think more about and should be at the center of the agenda. And this is information in financial markets and the real effect of information in financial markets, in particular, how people who make decisions in the real side of the economy, how they learn from prices. This is what we call the feedback effect, how financial markets affect what firms do. Um, so I'm, of course, gonna try to keep it not too long, given where we are and the stage of the evening. So I'm just going to give you kind of an overview of some leading ideas, the development, and some recent research on that, and conclude with some directions for future research that hopefully will give people some appetite to explore things further. So this is the outline that I have. I'm going to start with the basic premise of thinking about learning from the market. Why do we learn from the market? What's the idea behind it? I'm going to talk about how the empirical work in this area looked at that, the extent to which we can identify that there is learning from the market, what are the empirical strategies that we can take, and what are the challenges that we have in pursuing these strategies. Then I will show you a recent paper that we did. We call it Market Feedback Evidence from the Horse's Mouth, where we did a survey. And instead of trying to infer from the data whether people learn from the market, we asked them. And I will show you some of the things that we learned from that survey. I will talk a little bit about some of the implications that these ideas have for theory and how it changes the way that we think about market efficiency versus real efficiency. And as I said, I will conclude with a few future directions for research. So the basic premise, I think one of the key things that we know from financial economics is that market prices are supposed to be informative about asset fundamentals. Okay, you can trace this idea a long time back in the history of economic thought, and you can come back to Hayek, 1945, where he talks about prices generally. He talks about prices of goods and services, but this extends very easily to financial market prices. And he says that prices will be the key source of information for guiding production and allocation decisions. And this is because prices aggregate information from many different traders who are providing information that would be hard to generate otherwise. The idea is, if you think about the financial market, there are a lot of speculators who are busy producing information, trading on information. They have the best incentive in the world to have this information precise and to trade on it. And this is what they will do, and at the end of the day, market prices are going to reflect this information with some noise, but there will still be an information content in it. So that's one of the basic things that I think most of us believe about financial economics. Now, the feedback effect is really just taking it a step further and saying, if we really believe that there is all this information in market prices, then it would be just natural to believe that people in the real side of the economy are going to look at prices and update based on prices. learn from prices and take this into account when they make decisions. If you think about what prices will be useful, it can really be anything, right? Stock prices, futures prices, bond prices, depending on the context. If you think about who are the agents who may learn from prices, again, there are many that come to mind. Managers, creditors, regulators, customers, employees, and so on. Okay, so managers, it's quite natural. They make investment decisions. They have to consider what the price is telling them. But the same thing could be applied also to customers. If you want to know whether products of the firm are good or not, one source of information will be the market price. Employees, if you choose where to work, again, looking at the price of securities could give you some information. Now, the pushback that you often get is, well, many of these agents, in particular managers, they have first-hand information, so why do they need to learn from price? What do they need to update from the price? And my response to that is always, they could have a lot of information themselves, but as long as there is some information in the price that they don't know, you would expect them to look at the price and try to update based on the price, and that is exactly what this literature is about. So the literature focused mostly on managers learning from stock prices, and I will show you now some of the empirical evidence that have been collected over the years across a number of papers, and also the survey that I mentioned. But one thing that I will argue at the end is I think there is a lot more to think about in some of these other directions, in particular other stakeholders like customers, employees, and so on, also learning from prices and updating based on prices. Okay. So a brief overview of empirical work, strategies, and challenges. I will say that at the very basis of the idea, we need to recognize that there is clearly an empirical challenge in identifying people learning from prices. I mean, the first order thing that you would expect to see when you're thinking about learning from prices, you would expect to see prices go up, firms invest more, right? That would be kind of the first order thing to see. But of course, that doesn't tell you much, because there could be many reasons why prices and investment go up at the same time or one after the other. Of course, both of them could be reflecting some underlying fundamental, and as a result, they move together, but there is no causation from one to the other, okay? So the question is, how do you identify it from the data? And you need to realize that the key challenge here would be you don't really know what is the information set that people have, and you don't really know how they are updating, so you need to somehow identify it from the data. And I will say that the literature in general took two central strategies to try to tease out this causality from the data. And I will briefly talk about both of them with some examples. So one strategy is to say that, there is one thing that investment and price will be correlated, but if we believe this idea of learning, we should expect that the sensitivity of investment to price will be higher in some cases. So in those cases where we think that prices reveal more information that managers don't already have, right? In those cases where we think managers can learn more from the price, we will also expect to see a stronger sensitivity of investment to price. And that has been one leading strategy in the literature. So I have here a few examples of papers that followed that route. I'm not going to talk about all of them. Let me mention here the second bullet, which is one of my early papers on that, and also another paper by Buck and Whited, where we basically say that in order to measure the extent to which managers can learn from the price, we can rely on market microstructure measures of price informativeness, and then the basic prediction will be that the sensitivity of investment to price will be higher when prices are more informative according to these measures. Okay, and that was the initial test that we did, and that was followed later in other papers. And then there were other papers in the literature that looked at different ways to think about the extent to which we can learn from prices. For example, a paper by Foucault and Fressard, they look at cross-listed firms, saying that if you're cross-listed, then you have information coming from different markets that will make prices overall more informative. And then they show that the sensitivity of investment to price is higher in those cases where the firm is cross-listed. Another paper that they wrote is looking at peer firms. And here you have a lot of dimensions in which you can test the theory, because you basically say firms are going to learn from their own prices, but also from their peers' prices. And you basically get, for example, again, that the sensitivity of investment to your own price will increase when your own price is more informative, but the sensitivity of your investment to your peers' price will increase when your own price is less informative. So there are a lot of interesting interactions there that you can explore that they do. Let me maybe mention one more paper by Edmonds, Jayaraman, and Schneemeyer, where they look at the enforcement of insider trading laws, saying that when insider trading laws are enforced more strongly, the sensitivity of investment to price will increase. And the idea is that when there is less insider trading, managers have more to learn from the price because there will be more outside information going into the price. So again, just to summarize all this, the strategy has been to say, we're not just going to look at whether investment is sensitive to price, but we're going to check whether the sensitivity of investment to price is stronger in those cases where prices are expected to contain more relevant information. Okay. The other strategy in the empirical literature, which when you first say it, it sounds a bit surprising, but I think when you go into it, it makes a lot of sense. At least I pursued it, so I think it makes sense. But the idea here is to look at non-fundamental shocks to prices and see whether investment responds to non-fundamental shock. Okay? So what is the logic here? Well, the logic is, prices move for different reasons. Sometimes they move because there is an information shock. Sometimes they move because there is some noise. Okay? Now, managers who are trying to learn from the price, they don't necessarily know whether it's noise or information. They're just going to follow the price. But if you show that something that ex post you figure out was noise and managers still followed it, that suggests that they're really looking at the price and following the price and trying to learn from the price. Because otherwise, there is no reason that this shock to the price and investment would be correlated for any other reason if you indeed believe that the shock to the price is noise. And we did that in an early paper looking at extreme mutual fund outflows as a measure to non-fundamental shocks in prices. And again, a paper by Thierry Foucault and others used that in a different context. And that has been a leading measure of non-fundamental shocks in the context of this literature. I will say in general, and I'm not going to get into all the details of the literature, there is active debate on how you measure informativeness, how you measure mispricing. Those are very difficult concepts to measure, right? So what I want to say here is there is still a lot of room for this literature to develop, because we know what we are looking for, right? Showing that the sensitivity of investment to price is higher when informativeness is higher, showing that investment is responding to mispricing. However, given that those are still concepts that we are still figuring out exactly how to measure and how to capture, I would say there is still a lot more to do. And this is part of the message, that I think there is a lot of ground to still explore. I will say, though, that when you take the collection of papers and evidence, I think there is a good amount of evidence out there that prices do guide investments and that there is learning from the price. But as I mentioned, there is still more to do. And I will also highlight this byproduct that I think is quite important, which is that if we believe that managers learn from price or others learn from price, it turns out that noise in prices will also have a real effect. And I think this is something we always have to keep in mind when we think about financial markets. And I'll have a quote here from George Soros, who said, "In certain circumstances, financial markets can affect the so-called fundamentals which they are supposed to reflect." And I think that's exactly the gist of what I'm saying here. So let me move into the third part of the outline, which is the survey that we did, that I think is quite interesting. This is the title of the paper, Market Feedback Evidence from the Horse's Mouth. As you will see, it's a paper that developed over a number of years for a good reason. So this is with Bibo Liu and Lian Yang. I worked with Lian Yang on a lot of papers. And the paper is doing a survey in China. There is a collaboration between Tsinghua University and the CSRC, which is the Chinese SEC, that they do a survey every quarter asking Chinese firms a bunch of questions, and they have the flexibility to add some questions from academic for this kind of academic studies. And we teamed up with them for that purpose. The advantage of doing this survey in China is that you get almost 100% response rate. So if you're worried about selection bias in surveys, you don't have this selection bias there. This is part of their SEC work, and the firms are generally expected to respond. And you will, and I'm not going to have time to go into all the details, but we have a good indication that they really say what they think, because we validate their responses based on their behavior, and we see that there is a lot of correlation with firm characteristics and behaviors that will align with learning. So that's really an opportunity to do a direct test on market feedback theories. As you will see, we focus on the learning channel, and we can see how many firms say that they learn from the market, what are their characteristics, what type of information they learn, and so on. And there is also an opportunity, as I mentioned, to validate it and see how their behavior lines up with their responses. So just to give you a few highlights, and I will also say, we did this survey twice. We did it once in 2019, and then the other time in 2022. There was a version of the paper that was circulated after the first round of the survey. We got a lot of comments, and then we did a second round where we added, I think, a very important question. And also doing the two rounds also helped us see that the results are consistent. It's not just a one-time fluke that they said something and it doesn't mean much. So in general, the first dimension you may think about is whether managers care about prices. And I will say 97% of the responding firms say that they monitor the stock price. When you ask them why, you see that 80% say that they are learning from the price. 69% say that they care about the price for financing reasons. Obviously, these are not mutually exclusive, so it doesn't have to sum up to 100%. And then there are other reasons that we gave them that got less support than this. And then we could also ask them what are the dimensions that they learn about if they say that they learn from the price. And you will see that the dimensions that they say most frequently are macroeconomy and the industry, policy and regulation, and competition. So these are the things they are trying to learn from the price. And I will say these are the dimensions on which I think the importance of market information is particularly profound, because these are things that generally managers don't learn internally, but there is a lot of value from having the external aggregation of information. And finally, as I mentioned, we can also validate their responses by looking at how their responses correlate with their behavior. So for example, we do find that managers that say that they are more likely to learn from the price are those that have a higher sensitivity of investment to price. There is also something very interesting in China where firms are able to suspend their trading, and we see that managers who say that they learn from the price are much less likely to suspend their trading. Okay, so there are a lot of indications that what they say is indeed what they think. So just briefly to show you some of the results of the survey. So this is kind of the most basic question where they are asked, do you care about the stock price? And A here is, do you care about your own stock price? B is, do you care about the peer stock price? C is, do you care about both? And then the other things is, do you care only about an index, or maybe you don't care at all? You see that the vast majority of firms say they care about the price, and they care both about their own price and about their peer price. More informative is to ask them why. So why do you care about the price? And here we collected all the reasons that are generally mentioned in the literature. You can see that the two reasons that got the most support are the learning channel and the financing channel that I mentioned. So in the 2022 survey, 80% of the firms say that they are learning new information from the price. 69% of the firms say that they also care about the price for financing reasons, which means that, you know, if the price is high, they can do an SEO and they can raise more capital that way. When you look at other things that are mentioned in the literature, they got a lot less support. So C is that the price is a basis for compensation. So they have stock-based compensation. D is that the price will generate some pressure from the board and shareholders. And E is that if the price goes down, they become more vulnerable, more exposed to a takeover. Okay, so you can see that it's really those two things, learning and financing, that they overwhelmingly report as reasons for why they care about the price. And here, this is kind of the new addition, which is to ask them, okay, if you say that you learn about the price, what are the dimensions of information that you care about? And we gave them 8 different dimensions of information. If you go through them, I think all of them will make sense to you. The 8th one is a little odd. This is COVID-19, but the survey was done in 2022 when obviously COVID-19 was a big thing, in particular in China. So this question was, I think, needed at that point. But you can see that it's really the top 3 that get the most support. And this is what I said, the state of the economy and the industry, policies and regulation, and then the competition that the firm faces from the industry. And as I said, in general, when we think about learning from the price, remember the tension is managers already have a lot of information. So why do they need to learn from the price? And my answer is always, there are some pieces of information that you don't have internally, and that you get a lot from getting the aggregation from the market. And I think it makes sense that, you know, when you're trying to learn about the state of the industry or policy or competition, these are the things on which the aggregation of information in the price will matter a lot. The other things are getting a little less support, like cost of capital or technologies. Those are things that maybe firms have better information internally. So that's what we got from the survey. Okay, I will talk a little bit about implications that this has for theory of financial markets and corporate finance. Then I will conclude, and I will leave a few minutes for questions. So, you know, I wrote a couple of review papers on this, and we highlighted that once you accept that there is a feedback effect from the financial market to firms' decisions, It really changes the way you think about the price formation process, the trading process, and a lot of things we talk about in asset pricing and corporate finance. So one type of insight is that when you incorporate the feedback effect into models of trading in financial markets, it fundamentally changes predictions on the trading patterns and price formation, and it helps understanding some observed phenomena. And I will give you a few examples. The second one that I will spend a little more time on is that when you're thinking about this feedback effect, it really opens the door to talking about different notions of efficiency. And I will highlight here market efficiency versus real efficiency. Market efficiency is the extent to which the price is correlated with future firm cash flows. Real efficiency is the extent to which the information in the market helps make investment decisions and make those more efficient. I will say that the asset pricing literature primarily focused on the first, but the second is really what is important. So in some sense, I think there is a bit of a disconnect between what is measured in the literature and what we should care about. And I will show you that they could conflict with each other. And so this is something that I think we should pay attention to. So just a few examples of things that I've done over the years that highlight how the market feedback is changing trading patterns and the way that prices are being formed. So we talked about how the feedback effect can generate short sell price manipulation, how it can generate trading frenzies, or how it can generate asymmetric trading, or the phenomenon where bad news travels slowly. And those have been developed across different papers. I will not have time to get into it. Just to highlight this tension between market efficiency and real efficiency, and this is something that we are working on still in an ongoing paper. So think about the following. Think about multiple dimensions of information, okay? Let's say, as I mentioned several times before, the market has advantage in one dimension of information. Say the market can really aggregate information about the competition that the firm faces. But the firm has advantage in another dimension of information, let's say the production technology. The question is, who learns what, and whether we are going to get the kind of allocation that we want. Obviously, the optimal allocation will be that the firm is going to produce information about what it knows, which is the production technology, and the market is going to produce information about what it has advantage on, which is the competitive landscape. However, when we analyze the equilibrium outcomes, we realize that it might not end up being that way. The firm always wants to learn what the market doesn't learn, because the firm wants to produce new information to maximize the amount of information that goes into the decision. But the market sometimes has an incentive to produce the same information that the firm has already produced, because speculators in the market are just trying to make a profit, and in some sense they're just trying to predict what the firm is going to do. This is what we call the sensitivity of the final cash flow to the produced information is higher when you are producing the same information as the firm. So, a complex equilibrium analysis basically shows that depending on the ex-ante profitability of the investment, we can have an equilibrium where both the firm and the market end up producing the second type of information. And this is exactly the case where the market efficiency and real efficiency are in conflict. Market efficiency is going to be high because the market predicts what will happen, but the real efficiency here is extremely low because the market does not give any new information to the firm. This is where we have the conflict, and this is, I think, where potentially more policy or different market design could help in getting better outcomes out of the market. So let me briefly conclude, and then leave some time for a few questions. So I would say there are a lot of things that we could think about going forward with this literature, and I highlighted a few of them in this review paper in 2023. One is how fintech and changes in information technology are changing what happens in this feedback effect. And what I have in mind here, we always talk about fintech. At the end of the day, a lot of what we talk about in fintech is just the fact that there are new ways to produce, process, transmit information. These are inherently about how the market generates information and how it affects firms. So I think that with new information technologies, there is a lot more to explore potentially. Second, I think we started to scratch the surface on what exactly the firm wants to learn about, but there is potentially more to do about this because a lot of the literature was just in general, are firms sensitive to the market, but not specifically what kind of information they're trying to learn. This is something we could see a little more in the survey, but it's a little difficult to see in data from the field. Third, as I mentioned in the beginning, expanding the scope to explore learning by other parties, not just the managers, but customers, employees, and so on, I think could also be a fruitful area to explore. And fourth, which is the most general, is further integrating asset pricing with corporate finance. The field of finance for a long time has developed with these silos, so there are corporate finance people, asset pricing people. What I talk about here is really linking the two, right? How firm decisions are affected by the asset prices. And I think there is a lot to do here to really strengthen the connection between asset pricing and corporate finance. I will say one last thing, that in a current working paper that we have, we are trying to go a little bit in one of these directions and see the extent to which market feedback is guiding investment that firms are making in emerging technologies. These are AI and green technologies. Arguably, those are technologies in which there is a lot of uncertainty, and market guidance could be quite important. And indeed, we see that following market reaction to the announcement of such technologies, firms are adjusting plans for investment in those technologies, and you don't observe that for traditional technologies. So I think this really helps to shed some light on what information you could gain from the market, and the fact that the market can play quite an important role in the adoption of emerging technologies, which are, of course, central to economic development in our time, in particular thinking about AI and green technologies. Okay.